Tech down more than 10% from its recent peak hit in early September, but the sector is still the best performer this year. So what's on deck for tech? Let's ask top strategist Steve Milunovich with Wolfe Research. Steve, welcome back to Fast Money. Nice to see you.
Nice to see you too, Melissa. Thanks for having me.
A happy belated birthday. I understand your birthday was on Monday, so happy belated birthday. And it was an important milestone, which we will get to in just a moment. But Steve, I first wanted to get to all of the changes that you've seen in technology. You've lived through past bubbles, and a lot of people are trying to make the comparison of the time now to the internet bubble. And I'm wondering if you see that comparison at all.
Yeah, Melissa, I think it rhymes. It's clearly not exactly the same thing. The multiples actually aren't as high as they were back then. You had companies like Pets.com that seemed to make no sense, and yet today you have Chewy, which is doing quite well on the internet. So I think what we've seen is the maturation of the internet into real businesses. In the software space, we have SaaS, we have cloud. So there are a lot of things going on that create very large TAMs for tech. Having said that, I think a commonality is that the Fed has been extremely easy. Back then, it was money for Y2K. Now it's to offset COVID. So I do think we've gone to extremes. For example, the percentage of tech stocks over their 200-day moving average recently hit 80% for the first time in this rally, and it's now bouncing off that. You mentioned that tech stocks are down about 10%. They've still got another 10 or 12% to go to get back to their 200-day moving average. So I think at this point, you would say it's a relatively normal correction. We'll see how it plays out.
Hey, Steve, it's Dan. Great to have you on here. Just a quick one here. You know, you look at this MAGA complex, the Microsoft, the Apple, the Google, the Amazon, they're this $1 trillion club. Some are $2 trillion club. If we were to have a pullback over the next few months, 6 months or whatever it is, what is the one name of those names that you're buying hand over fist that you think a decade out will be a $5 trillion company?
Well, that's a good question. You know, they're still fairly reasonably priced. And, you know, there's a lot of regulatory risk to the FANG type names. But historically, what we've seen is that the regulatory problems weren't what torpedoed IBM and Microsoft. It was new disruptive technology. And I generally don't see that for these names. So for the most part, I'd be wanting to buy most of them on weakness. I think Facebook is interesting. We talk a lot about the optionality of companies moving into adjacencies. And as much as Facebook is attacked for many things these days, they have a lot of optionality going into augmented reality with Oculus, trying to do currency and so forth. So that would probably still be one I'd be very interested in. But in general, I think the MAGA names are ones that I want to be buying on weakness still.
Steve, it's Guy. Listen, congratulations on an incredible career. And I want to ask you about that quickly. You know, you've been doing this a long time, and you've done it amazingly well. Is there one you wish you got back in terms of calls or stocks or just thematic things when you think about over the last, couple decades?
That's a great question, Guy. It's funny because I'm probably known for covering IBM. IBM's relative performance peaked in 1987, so it's been important to find other names along the way. I was fortunate to pick up Apple around 2001, and the stock was in the single digits, considering splits. I wish I'd been even stronger on that one. Interestingly, I actually covered alternative energy for a few years. I was one of the first analysts and probably the first tech analyst to cover Tesla. And the stock went from 15 to 25, and kind of like with Apple back in the day, you thought, wow, that was fantastic. A lot of people got out of the stock. No idea it was going to go up 10x from there. And over time, I kind of went over the auto analyst. So Tesla is one of the names that I kind of wish I'd been able to keep coverage of over time. But it's funny, as an analyst, you can get associated with one big name, whether it's a Microsoft, an Apple, a Tesla. You can make a career on that.
Yeah. Fortunately, you're not the only association, Steve, isn't with IBM at this point. It's with many of the other great calls you've made over the course of your career. And the reason why we're saying this for the audience out there, Steve is retiring at the end of the month, hence the mention of his birthday. He turned 60 on Monday. So, Steve, congratulations on your retirement, on your birthday. Thank you for sharing your insights on CNBC. We always love having you on. We appreciate it.
Well, thank you, Melissa. Very kind of you, and I appreciate all your interest.
All right, Steve Milunovich, we wish you the best.
Thank you.
Tim, what's the one area in tech that you think that you underestimated over the past decade?
Well, there's so many. Boy, where to start? I do think that what Steve has pointed out is that great analysts find a way to look at the world differently, and the world changes. And technology never has there been, more kind of generational and light speed changes. So for me, it's about someone who's been born out of a value construct, seeing high growth names, high multiple names, and holding my nose at many times over the last 5 to 10 years. Understanding that certain trends and judging companies on, for example, EV to sales isn't taboo. And I think in tech, when you have top line growth, it is worth paying for. There have been game changing companies that I've certainly missed, and I'm trying to do that differently every day.